Hello students, so if your subject is management and your paper is in January 7th, then this video is very important for you. So welcoming everyone to the Global Online channel. I am your educator Nihal. In this video, we will discuss 100 plus expected MCQs for paper 2 management, and by watching this video, you can revise your important topics from the paper 2 management and you can boost your score in the upcoming examination. So you need to watch this video till the end and share as maximum as you can. And if you are planning to attempt the 2026 UGC NET examination from the paper 2 management background, we are providing paper 2 management complete course for those students who are seriously preparing for the 2026 UGC NET examination. In this course, you will getting complete video lectures, complete syllabus notes, mock test for examination like feeling, PYQs with explanation, doubt clearing sessions, marathons, all the things will be provided for your complete preparation for management paper 2. If you want to join this course for 2026 examination, just give a WhatsApp message or WhatsApp call on this number and join the course and start your preparation.
All right, so this is first question you can see on your screen. Which of the following is not a capital budgeting techniques? So there are different kind of capital budgeting techniques. So in the options, there is a one option which is not included in the capital budgeting technique. Okay, so which of it? Payback period, NPV, IRR, or debt equity ratio. Okay, so it is straight and clear that option D is the correct answer, because debt equity ratio is not the technique for capital budgeting. Okay, debt equity ratio is there in the financial ratios that we have discussed, how to solve the debt equity ratio. Okay, so this is not the thing. See, debt equity ratio is the capital structure or leverage ratio, not capital budgeting technique. Correct. So capital budgeting tools evaluate investment viability like NPV, IRR, payback, PI. These are the techniques to solve the capital budgeting techniques. Oh, sorry, capital budgeting questions. Clear? So these all we will be discussing. Clear? Next is this question is on the payback period. This is the one of the technique of capital budgeting, right? So question is, the payback method primarily ignores which factor? Initial investment, cash inflows, time value of money, or liquidity. So what is it? It is time value of money. See, payback method is the only considers how quickly the investment is recovered, right? So payback method will give you the idea the how much time it will take to pay the remaining things, right? So it will give you the clear idea how quickly the investment is recovered. Okay, it ignores the timing value of a money and cash flows beyond the payback point. Clear? Next, which of the following uses the discount rate that makes NPV is equal to 0? Accounting rate of return, payback period, internal rate of return, or profitability index. Okay, so it is internal rate of return, which we called IRR in short term. Correct. See, IRR is the discount rate where total PV inflows is equal to total PV outflows, right? That is why NPV will be is equal to 0. Next question. So this kind of questions that we are discussing, like this question is asking about the PI formula. Okay, so it will be giving you the formula also, and on that kind of thing they can ask different questions, right? They may give you a partially formula and a remaining part will be the blank, right? So they can ask which of the following is the correct option, which is fulfilling the correct formula. Correct? Getting it what I'm trying to say? So option A, PV of cash inflows divided by PV of cash outflows. B, cash inflows divided by cash outflows. C, NPV divided by cash outflows. And D, cash inflows minus cash outflows. So right answer is option A, that is PV of cash inflows divided by cash outflows. Okay, this is the formula: PV inflows divided by PV outflows. If PI is greater than 1, it is accept project. Okay, it is accepted. Next question, if the initial investment is rupees 1 lakh and the PV of cash inflows is 1,40,000, the PI will be what? Okay, so just we have discussed the formula of PI. What is it? PV inflows divided by PV outflows. Okay, so investment is 1 lakh and the PV of cash inflows is 1,40,000. So investment, that means outflow, right? Our cash flow is getting out, getting it, that is why we have invested. So 1 lakh and 1,40,000. So inflows, right, divided by outflows, right? What will be the answer? Here also 1.40. Answer should be 1.40. Option B, right? Option B will be the correct answer. Here you can see. So PV inflows divided by PV outflows, 1,40,000 divided by 1 lakh. Option will right answer will be 1.40. Which technique is considered superior as it considers both time value of money and cash flow after payback? Okay, A payback period, B NPV, C ARR, and D payback reciprocal. So option B NPV will be the correct. NPV is theoretically the best method as it considers both the time value and all cash flows. Okay, if IRR is greater than the cost of capital, then the project is rejected, accepted, kept in abeyance, or indifference. So just we have discussed, right? It is accepted. IRR is greater than cost of capital, then it will be accepted. This project will be accepted. Okay, when IRR is greater than cost of capital, the project generates more than required return. Okay, that will be accepted. Which of the following is not discounted technique, non-discounted technique? Payback period, NPV, IRR, or PI? It is payback period. It is a non-discounted technique. Okay, payback and ARR are non-discounted methods. They don't consider time value of money. Which of the following is also known as average rate of return, which is ARR? IRR, ARR, that means accounting rate of return, NPV, and payback reciprocal. So it is accounting rate of return. Which of the following is also known as average rate of return? It is accounting rate of return. Okay, ARR, average annual accounting profit divided by average investment. So we will have ARR. Okay, if the NPV, in the NPV technique, a project is accepted if NPV is greater than 0, sorry, is less than 0, NPV is equal to 0, NPV is greater than or equal to 0, or NPV is less than or equal to 0. So right answer is option C. NPV is greater than or is equal to 0. Okay, NPV, present value of inflows minus present value of outflows. Okay, if NPV is greater than or is equal to 0, the project adds wealth and is acceptable. Okay, remember these formulas and how it is calculated and what will be the result of it. Okay, which of the following techniques is also called the discounted cash flow, DCF technique? Payback period, net present value, accounting rate of return, or payback reciprocal. So the right answer is option B, net present value. It is also called the DCF, that is discounted cash flow technique. Okay, see, DCF technique discounted future cash flows at cost of capital. Remember this. Okay, DCF techniques discount future cash flows at the cost of capital, and NPV is the most popular DCF technique. Getting it? So basically NPV is included in the DCF techniques. Okay, it is a part of that, and payback and ARR are not discounted techniques, which is not considered in the DCF techniques basically. So NPV is the kind of a DCF techniques, that is why it is considered as a DCF. Understanding? Next, this is the calculative question. An investment requires 40,000 rupees. It generates cash inflows of 10,000, 12,000, 14,000, and 15,000 respectively. Correct. In the 4 years. Find the payback period. Okay. In the previous session, we have discussed the formula of payback period. Okay, how to calculate these kind of questions. Now I'll explain you how to solve these questions. Okay, first the right answer is option is 3 years, option B 3 years. Now first thing, remember how much we need, how much we require. 40,000, correct? 40,000 we required. That means the investment we require, right? Investment, that means it is the outflow. Getting it? And in the question they have given the inflow, correct? 4-year inflow, and we need 40,000 only for investment. Now first year, okay, the inflow was 10,000. Cumulative, if we consider, it will be 10,000 only, because this is the first one. Then second year it is 12,000, so we can add in the 10,000, it will become the cumulative 22,000. Then third year, okay, inflow was added 14,000, so we will add it in a 22,000, it will become 36,000, right? And then in the fourth year, 15,000 inflow was there, and cumulatively it is 51,000, correct? But in the third year it is 36,000 only. It is 36,000 only. That means what, how much we need extra? We need 4,000 extra, correct? Here I have calculated recover fully in 3 years. It should be recovered in a 3 years, right? So 36,000 was inflow and we needed 40,000 for the investment, right? So 4,000 we needed extra. So the 40,000 minus 36,000, we need 4,000 extra, right? But in the fourth year, 15,000 inflow was added, right? So it is covered 4,000. 4,000 was covered in the fourth year, correct? So 4,000, okay, divided by 15,000, we have 0.27 year. What is it? 0.27 year, correct? So total payback is 3 plus 0.27, that means 3.27 years. Okay, payback period will be 3.27 years. So basically we consider it 3 years. Okay, so right answer was 3 years. Next question. The reinvestment assumption in IRR method is that intermediate cash inflows are reinvested at cost of capital, IRR, risk-free rate, or market rate. It is the IRR. Okay. NPV assumes reinvestment at a cost of capital, whereas IRR assumes reinvestment at IRR itself. Okay, remember this point. Next, a project cost 50,000 and generates annual cash inflows of 15,000. Okay, project cost is 50,000 and annually the inflow from that project is 15,000, okay, for 5 years. The discount rate is 10%, okay, and use PV factor of 10% for 5 years, 3.791. Find the NPV. Okay, so NPV will be 6,865. How? So PV of inflow 15,000 per year we have. Okay, 3.791, it is totally calculated and they have given in the question itself. So right answer will be PV of inflow will be 56,865, right? So NPV, now we need to calculate NPV. So NPV is equal to 56,865, that is your PV of inflow, minus 50,000. What is it? Project cost, correct? So what will be the answer? 6,865, right? So as per this, decision will be, it will be accepted since NPV is greater than the 0. Okay, NPV is greater than the project cost, right? So it will be accepted. Next, which of the following methods gives multiple results when cash flows are unconventional, like sign changes? Okay, NPV, IRR, ARR, or payback? Right answer is IRR. If cash flows alternate between positive and negative more than once, IRR can give multiple solutions while NPV gives unique value. Okay. Project requires 1,20,000, PV of inflow 1,50,000. Find the profitability index, right? So right answer will be 1.25. How it is? PI is equal to PV inflows divided by PV outflows, correct? So 1,50,000 we have inflow and 1,20,000 we have outflow. So right answer will be 1.25. It is as simple as, okay. Which method is appropriate for ranking mutually exclusive projects? Payback, ARR, IRR, NPV. Right answer is NPV. Mutually exclusive, one only project can be chosen. NPV is the best as a measures absolute wealth addition. So that is why the right answer was that. A project requires 2 lakh, expected annual accounting profit 40,000, average investment 1 lakh. Find ARR. Okay, so 20% will be the answer. How? ARR formula we need to understand first. What is formula of that ARR? Average annual profit divided by average investment into 100. Okay, 40,000 given, 2 lakh is given, into 100, 20% will be the right answer. Okay, it is really very easy, but only when you remember the formula. Next, a project cost 1 lakh. It generates annual inflow 25,000 for 5 years. Find approximate IRR. Okay, PV factor 10%. Okay, for 5 years, that is calculated. PV factor at 15% for 5 years is 3.352. Okay, right answer will be 14%. See here, at 10%, PV is 25,000. Okay, into 3.791, it will be 94,775. Okay, at 15%, PV is 25,000 into 3.352 is equal to 83,800. Okay, cost is greater, but still it is less than 10%. Getting it? Interpolation will be IRR 10% plus 94,775 minus 1 lakh divided by 94,775 minus 83,800. Okay, into 15% minus 10%. Okay, then 10% plus this is calculated. Okay, the 15 minus 10, then 5% will be remaining. 10% minus 2.38%. So right answer will be 12%. Right, so it should be more than 12%. Okay, it is more than 12%, correct. Actually it is 12.38%. So it is more than 12%. So it should come under the 12 to 13, correct, 12 to 13 range or 12 to 13 category, correct. But there was no option like a 13 or 12.38, right. 12 was there, but it is not exactly 12, it was 12.38. That means just little bit more than 12%. So it should come under the 12 to 13 or uske आसपास, right. So 14 was there in the option, so 14 will be the correct answer. Okay, sometimes ऐसे भी होता है, right. Exactly point wise answer तो नहीं रहेगा ऑप्शन में, but you have to correct the option which is nearly, okay, correct answer. So 14 will be the correct answer.
Okay, first thing I would like to tell you, these sessions will be totally in the English. So people who are preparing in the English language, it will be beneficial for you. Try to answer the question in the comment box. Okay, contribution per unit is defined as, okay, so contribution we know. So what is contribution, how it is calculated, the formula is given, the right formula is given in the option. So you have to choose the correct option. A, selling price minus fixed cost. B, selling price minus variable cost. C, selling price minus total cost. Or D, selling price minus semi variable cost. So what is the correct answer? What is contribution? Contribution is nothing but the selling price minus variable cost. Okay, see, this is the formula. Contribution is equal to selling price minus variable cost. Okay, so this amount contributes to the covering fixed cost and then profit. Okay, I'll explain you how it is. Fixed costs are not subtracted when computing contribution per unit. Why? See, for example, imagine you sell one product. Okay, you're selling one product which is anything, and from the selling price, okay, you first minus the variable cost. From the selling price you need to minus the variable cost, correct, and whatever it is remaining, that is called contribution. So when we minus the variable cost from the selling price, you will get the contribution. Correct? Why we call it contribution? Because it is contributing. Okay, it contributes first to the cover the fixed cost. So whatever the fixed cost, you have to cover it, right? You have to cover it by selling the product. Then you will matched with the fixed cost, right? And then you will calculate your profit. Then you can make the profit. For example, okay, if the selling price is rupees 20 and variable cost is rupees 12, so what will be the contribution? Contribution will be your 8 rupees, right? So contribution is nothing but your profit. Okay, I'll explain you how. So fixed cost is 800 rupees, right? Fixed cost is rupees 800. Getting it? So if you want to make a profit, you need to match to the 800 rupees. So how you will match? You must sell 100 units, right? You must sell 100 units, which is 800 divided by 8. That will be your 100 units, right? So just to cover the fixed cost, you need to sell the 100 units of your products, right? You will sell 100 units, you will get the 800 rupees fixed cost. You profit, your matching with the fixed cost will be correct. Getting it? So contribution will be 8 rupees, right? First you need to match with the fixed cost, then you will make a profit. Getting it? This is the thing you have to by heart this formula, right? याद कर लो ये formula, very important. Contribution is selling price minus variable cost, right? So we need to match with the fixed cost, so that is why we need to calculate the contribution. Once we calculate the contribution, then you will match with the fixed cost, like how much unit you need to sell, right? And then your profit will be there. Next, margin of safety, MOS we call it in a short. Margin of safety in rupees is defined as A. Break-even sales minus actual sales. B. Actual sales minus break-even sales. C. Fixed cost minus variable cost. Or D. Contribution minus fixed cost. What is it? Dimple, you can answer in a comment box. Okay, you have correctly answered the previous question. Very good. Very good. Option B is the exactly correct answer. Actual sales minus break-even sales. Okay. So basically margin of safety, right? Margin of safety is actually the thing which tells you how much your sales, okay, fall before starting making the loss. Am I right? So how much your sales fall, getting it, before starting the loss. So formula for that is actual sales minus break-even sales. Great. So more the margin of safety, more the safer business, and the less the margin of safety, the business will be in the more risk. Getting it? For example, if your sales are rupees 1 lakh rupees and your break-even sales are rupees 70,000, so margin of safety will be 30,000. Getting it? So if your sales can fall by 30%, then still you won't be in a loss. Getting it? If your sale is fall by 30%, that means 30% of 1 lakh rupees, 30,000. Getting it? So we have a margin of safety 30,000. So you will be not in the risk. Your business will not be in the risk. Okay, because margin of safety is already you have 30,000 and the 30% sale is falling. Getting it? So there will be no changes. There will be no risk in the business. Next question. In a standard costing, material price variance, we call it MPV. Okay, so what is the formula of MPV? A. Standard price minus actual price into actual quantity. B. Actual price minus standard price into standard quantity. C. Actual price minus standard price into actual quantity. Or standard price minus actual price into standard quantity. What will be the correct answer? Give it in a comment box. So right answer of this question is option C. Okay, actual price minus standard price. Okay, great. Into actual quantity. Okay, so MPV is equal to actual price minus standard price, right? Into actual quantity purchased. Correct. A favorable variance when actual price is less than standard price gives a negative or favorable result if using the sign conventions. Okay, the formula captures the price difference on an actual quantity. Actually, it is saying about the formula. So when you buy raw material, you expect to pay a standard price, correct? If you are buying the raw material, you are expecting to pay the standard price, right? But in reality, you may pay actual price, right? In the reality, you may end up with the paying the actual price, AP, right? So the difference between them multiplied by how much you purchased is MPV. Understanding how it is calculated? When you are buying a raw material, you are expecting to pay the standard price, which is the regular price, correct? But in reality, you end up with the paying the actual price, right? And so difference between these both will be multiplied, and how much you have purchased, which is multiplied, it is called MPV. That means into actual quantity purchased. Getting it? So that is the formula. MPV is equal to AP, right, minus SP into AQ. That means actual quantity. Getting it? So basically, for example, we can take if manlo, if your standard price is rupees 5 per kg and your actual price is 4 per kg. Okay, rupees 4 per kg. Getting it? So the actual quantity is rupees actual quantity is 1000 kg. Getting it? Actual quantity is 1000 kg. So MP will be what? 4 minus 5. That means standard price 5 rupees kg and actual price 4 rupees kg, right? So actual price 4 minus 5 into 1000. Okay, so it will be into the in the minus 1000. The answer will be in the minus. Getting it? So it will be favorable because you save the money. Understanding? Because you have saved your money. So that is why it is called favorable, because it is in minus, right? So this is what your MPV, material price variance. Got it, got it. Ulta pulta ho gaya ye. The actual formula is standard price minus actual price. Okay. Material usage or material quantity. Okay. The variance formula is material usage variance formula is, okay, which we call it MUV. Okay, material usage variance. Standard quantity minus actual quantity into standard price, or B, actual quantity minus standard quantity into actual price, or C, actual quantity minus standard quantity into standard price, or D, standard quantity minus actual quantity into actual price. Okay, A, B, C, D, whatever it is, try to answer, because in this examination, there is no negative marking. So whatever, if you know the answer, if you don't know the answer, just try to give the answer. Okay, if you know the answer, that will be great. If you don't know, try to attempt the answer. Okay, never know, you will end up with the selecting the correct answer even if you don't know the answer, right? So you will have a great marks. So try to practice with the attempting all the questions. So right answer is option A. See, material usage variance standard quantity allowed for actual output minus actual quantity used into standard price. Okay, so basically this is about how much material you have used, right, versus how much you were supposed to use, right, for the given production. So that is the difference, which is MUV, correct? Next question is about variable overhead efficiency variance is computed on the basis of, okay, variable overhead efficiency variance. Okay, A is computed on the basis of A, actual hours into standard rate minus budgeted variable OH. Okay, OH means overhead. Okay, B, standard hours minus actual hours into standard variable overheads rate per hour. Clear? Then actual hours minus standard hours into actual variable overheads rate, or option D, standard hours minus actual hours into actual variable overhead rate. Give your answer. So right answer is option B. Okay, the standard hours minus actual hours into standard variable overhead rate per hour. Okay, next, fixed overhead volume variance arises because A,
Actual fixed overheads differs from the budgeted fixed overheads. B. Capacity utilization differ from the expected, causing difference between the budgeted and absorbed fixed overheads. C. Variable overhead spending differs from the standard. Or D. Sales mix differs from the budgeted mix. Okay, the right answer is option B. Okay, that is capacity utilization differs from the expected, causing difference between budgeted and absorbed fixed overheads. Okay, see, the variance comes because actual activity, the production level is different from the budgeted levels. Getting it? And the formula we have seen, the budgeted fixed overheads minus absorbed fixed overheads based on that standard hours for actual output. Getting it? So if you work less than expected, okay, that is the adverse variance, and if you work more than expected, that will be favorable variance. Next, sales margin variance is caused by, okay, sales margin, that is profit. Sales margin variance is caused by difference in actual sales quantity only. B. Difference in actual selling price only. C. Difference in both price and quantity from budget only. Or D. Difference in cost only. So right answer is option C. Difference in both price and quantity from budget. In standard costing, which variance is controllable by factory superintendent? Material price variance, material usage variance, sales price variance, or fixed overhead expenditure variance? It is option B, material usage variance. Next. Which department is mainly responsible for material price variance? Purchase department, production, sales, or accounts? So right answer is purchase department. Labor efficiency variance is generally the responsibility of personal or HR department, factory or production department, purchase department, or accounts department. What is it? It is factory or production department. So if selling price is 50 rupees and variable cost per unit is 30 rupees, right? And fixed cost is also given, which is 8,000 rupees. So what will be the break even sales in units? Okay, remember, sometimes what happens, it will give you in a price or it will give you in a units. So formula for the both may be different. Okay, so always read your question first very carefully and then try to answer. So selling price is 50 rupees, variable is 30, and fixed cost is 8,000 rupees. So you have to match to that 8,000 rupees, okay, to make a profit, right? So what will the break even sales in unit? Find out, and you can give your answer in the chat box. Okay, is it 200 units, 400, 500 units, or 800 units? Give your answer in a comment box. All right, so right answer is option B, that is 400 units. Okay, if you remember, we have discussed the contribution formula in the previous session, right? Understood? So the selling price minus variable cost, okay, you will have the contribution, correct? So contribution we calculated, okay, so according to that we can cross verify, right? Cross calculation we can do. The break even units, okay, is equal to fixed cost divided by contribution per unit. Getting it? So what is your fixed cost? It is 8,000 rupees. Contribution per unit is your 20 rupees. Okay, so what will be the answer? 400 units. So right answer was option B, 400 units. Okay, see, first you need to calculate the contribution, okay, because the formula for break even units is fixed cost divided by contribution per unit. So contribution is not given in the question, you have to solve it by yourself. Okay, so first we have calculated the contribution, which is selling price, right, minus variable cost, 50 minus 30, 20 rupees your contribution per unit. So if you divide your contribution, okay, by the sorry the your fixed cost divided by the contribution, you will have the break even units. What is it? Units. Okay, I'm talking about the units, not the price, right? So this is the formula for the break even units. Okay, so 400 units will be your right answer. Next question. If contribution is equal to 60,000 and sales is equal to 2 lakh, the PV ratio is equal to question mark. So contribution is given, sales is given. What will be the PV ratio? If you remember the PV ratio formula, you will able to answer this question. 30%, 20%, 40% or 25%. What will be the correct answer? So right answer is 30%. Okay. See the formula. So PV ratio's formula is contribution upon sales into 100. So contribution, it is given in the question, it is 60,000 divided by sales, it is also given in the question, that is 2 lakh rupees. Okay. So into 100 when we do 60,000 divided by 2 lakh, the answer will be 0.30. Into 100 when we do, you will have the answer 30%. Remember, if any question is asking about the percentage, it should be into 100 always, whether it is in paper 1 or paper 2. If question is asking about to calculate the percentage, the question will be, the answer will be calculated in the, so whatever the amount which is given, you have to do into 100, so you will have the percentage. Okay. Next, a company has fixed cost 1,20,000 and PV ratio is 25%. Okay, so here the PV ratio is given and the fixed cost is also given. So what will the break even sales? So here the units is not asked. Okay, the question is not asking about the units, it is in the rupees. Getting it? So give your answer. Students, please try to answer in a comment box. Okay, whatever A, B, C, D, just give your answer. Whether it is wrong doesn't matter, because we are studying here, right? So even in the examination there is no negative marking, so you can attempt the questions, try to attempt the questions. A, B, C, D, whatever it is, just give your answer in a comment box. So right answer is option B, that is 4,80,000. Okay, see the formula. Break even sales in rupees we are calculating, correct? So fixed cost divided by PV ratio, that is the formula for break even sales in rupees, right? So let's calculate it. So 1,20,000 divided by 0.25, that means 25%. Okay, it will be taken as a 25, 0.25, right? So the answer will be 4,80,000. Okay. See, a product standard 2 kg material per unit at 10 rupees per kg. Getting it? So here what is happening? 2 kg material per unit. That means 2 kg, right? 2 kg is considered as a 1 unit. Correct? 2 kg is considered as a 1 unit, right? And the price for it per unit is 10 kg, 10 rupees per kg, right? Actual production is 1000 units. The actual production is 1000 units. Okay, so 2 kg per material at 10 rupees per kg and 100 units are there. Okay, so there will be 2000 units, correct? Am I right? 2000 units will be there. So actual material used 1900 kg. Okay, so 2000 units are total in actual, and actually used 1900 kg. Okay, actual price is rupees 11 per kg. So what is material usage variance? It is favorable or unfavorable. Okay, remember, whenever we calculate MUV or MVP, okay, that time we need to calculate, and we need to tell that which is favorable or unfavorable. Getting it? So here in this term, the everything is given, the units are given, the actual material used is given, okay, uh, actual production is also given. So we need to calculate MUV. So what is the formula of MUV? So right answer is 1000. It is favorable. How it is calculated? Try to understand. Standard quantity allowed. As I said, the 1 unit is what? 2 kg. Okay, so 2 kg is equal to 1 unit. So we have 1000 units. So 2 kg into 1000 units, that means we have 2000 kg. Getting it? 2000 kg we have. So actually it is used 1009 kg, 1900 kg. Actually 1900 kg from the 2000 kg is only used, right? So we have a 100 rupees difference in that. So what is the MUV formula? Standard quantity minus actual quantity into standard price. Okay, so we have standard quantity 2000 kg, actually quantity we have used 1900. Okay, so we will minus from the standard, so you will have 100 quantities remaining, right? Sorry, 100 kg remaining, and into 10. 10 is what? It is standard price, which is given here. This is standard price. Okay, actual price is not taken. Okay, in the formula the standard price we need to take. So when we multiply the remaining kg or remaining units, okay, with the standard price, we will have the MUV. So 1000 rupees. Okay, it is in positive way, so it is favorable. Okay, since the actual the quantity is less than the standard, so variance is favorable. Okay, understood everyone? Next, using data, standard labor time per unit is 4 hours. Okay, at 50 rupees per hour, produced 500 units, and actual labor time is 1900 hours. Actual rate 48 rupees per hour. What will be the labor efficiency variance? So yesterday we have discussed about this formula, right? So what will be the correct answer as per this given using given data? A, B, C, D, whatever, you have to give it the answer in the comment box. All right, so 5000 favorable, it is calculated. See, whenever the answer is coming, it should be favorable or adverse. Okay, depending on the answer. If it is negative, it will be adverse. If it is positive, it will be favorable. See, standard time allowed 4 hours, right? And 500 units is produced, right? The labor time per unit is 4 hour, and the production is 500 unit, right? So we have 2000 hours, that is standard time. So efficiency variance formula is standard hours minus actual hours into standard rate. Okay, so we have standard hours 2000, we calculated it. Actual hours is taken 1900. Okay, into 50. What is 50? That is standard rate. Okay, so we have 100 remaining hours into 50 standard rate, we have 5000 rupees favorable. It is in positive, right? So that is why it is favorable. So actual hours are less than the standards, so it is favorable. Using same data, that means the previous data that we have taken for this question, using the same data, standard labor time per unit 4 hours at 50 rupees per hour, produced 500 units, actual labor time is 1900 hours, and actual rate is 48 rupees per hour, right? So what will be the labor rate variance? Here we have calculated labor efficiency variance, okay, and here the labor rate variance, right? So right answer will be option C, 3800 favorable. How it is calculated? The rate variance formula is actual rate minus standard rate into actual hours. Okay, actual rate minus standard rate into actual hours. When we calculate it, we will have labor rate variance. Clear? So we have actual rate 48 rupees, right? Standard rate 50 rupees, right? And the actual hours is taken 1900, right? So here, if we calculate actual rate is 48, right, and the standard which is 50 rupees, we will have the answer in the minus, right? So when we calculate minus 2 into 1900, so the calculation will be minus 3800. It is also favorable. Why? Because the actual rate, right, the actual hours, the actual minimum the price, okay, is less than the what, less than the standard one. Getting it? So it is favorable because whatever it is necessary, we have produced in the less, right? Whatever the budget was given. For example, if we have 100 rupees budget and we need to calculate in the 100 rupees budget the minimum 100 units, right? And we need to take only, we have only 5 days, but what we have done, we have completed in 3 days with the 90 rupees. So we have done in the minimum one, right? So that is why it is favorable. Whether it is in minus, it is favorable. Clear? Company has the standard 1.5 kg material per unit. Where's the cursor? 1.5 kg material per unit at rupees 20 per kg, produced 2000 units. Okay, so company has this kind of standard 1.5 kg material per unit at rupees 20 per kg. This is the rate, okay, standard rate, and company has produced 2000 units. The actual material used 3100 kg at 90 rupees per kg. Okay, so standard is given, actual is given. So what will be the material price variance, MPV? Okay, what will be the MPV? So if you remember the formula, try to calculate it. So right answer is 3100, favorable. Okay, let's calculate it. MPV formula is standard price minus actual price into actual quantity. So we have standard price rupees 20, actual price rupees 90, okay, into 3100, that is actual quantity. Okay, so we'll have 1 into 3100, that means 3100 will be the right answer. Okay, so option A, 3100, favorable. Clear? Using the same data that we have used in the previous question, 1.5 kg material per unit at 20 rupees per kg, produce 2000 units. Okay, actual material is 3100 kg, that is used at rupees 90 per kg. So what will be the MUV? Again, MUV, the question is arised. So right answer is 2000 adverse. Why? Let's calculate. Okay, standard quantity we need to calculate first. Okay, whatever what is actual one is. So 1.5 right, the kg per unit, right, and 2000 what, 2000 is the produced units. Okay, so what we have, the 3000 kg will have. Okay, the standard quantity it is. Actually used 3100, so we have used 100 kg extra, right? Usage variance, standard minus actual into standard price. Very easy formula. Okay, it looks hard, but it is actually very easy. What we are doing, we are just calculating what is the standard quantity, what is the standard price, what is the standard rate, what is the standard hours. Okay, and we are just minimizing those, or we are just comparing those with the actual we have used. And if it is less, that will be favorable. If it is not less, if we are using more than that, it is not favorable, it is adverse. Okay, but we need to calculate it in a standard formula, right? So that is why we need to do this. So what is the formula of MUV? Standard minus actual into standard price. So we have standard standard of quantity 3000 minus actually we have used 2100 into 20, that is standard price, will have the answer minus 2000. Okay, it is in rupees, not in quantity, it is in rupees. So minus 2000 will be the answer, so it is in adverse. Okay, so right answer will be the option A, 2000 adverse. Next, the product standard material 4 kg at rupees 5 per kg, produced 1200 units. Okay, actual material used 4800 kg at rupees 6 per kg, total material variance 4800 adverse again. So standard cost will be the 4 into 1200, okay, into 5. So right answer will be 24,000. Right, so actual cost is 4800, okay, kg, and add rupees 6, so 28,800 the actual cost. Standard cost is 24, actual cost is 28,800. Okay, so total variance formula is actual minus standard, right? So 28,800 minus 24, we have 4,800 adverse. Okay, so right answer is option A, 4,800. If the standard hours allowed for actual output are 1,500 hours, actual hours worked 1,650, more than that, and standard variable overhead rate is rupees 10 per hour, what will be the variable overhead efficiency variance? We have discussed this formula yesterday, right? All right, so right answer is 1500 adverse. Okay, see efficiency variance formula, standard hours minus actual hours into standard variance overhead rate. Okay, so we have standard hours 1500 and actually we have used 1650, right, into 10, what is that is standard variance overhead rate. So 150 is in minus, so that means we have used more 150 hours. Okay, so answer will be in the minus, right? So 150 into 10 will be the 1500 minus, so it is in adverse. So right answer is option E, 1500 adverse.
Which industry generally requires highest working capital? Okay, so one of the industry in the options is there, and this industry generally requires more working capital. Okay, which industry is this? Steel industry, construction industry, retail trading, or IT services? That is your retail trading. Okay, see, retail requires heavy investment. Why? Because in inventory, receivables, continuous cash transactions, this is very important things for the retail industry to run the business, to smoothly function the business, right? Steel constructions are capital intensive but not as liquidity heavy, right? So they need only the long term assets or long term capital, correct? But the retail industries that needs the inventory, receivables, continuous cash transactions. For that reason, they need more working capital. IT services need relatively less inventory. Thus, retail trade has maximum working capital demand, right? Next, net working capital is defined as total assets minus total liability, current assets minus current liabilities, fixed assets minus long-term liabilities, or cash plus receivables. So net working capital, that means your current assets minus current liabilities. Okay, when you minimize the liabilities from the current assets, total current assets, you will get the net working capital. Net working capital is the difference between current assets and current liabilities. Just we have seen the formula. When we minimize the total liability from the total assets, we will get the net working capital, right? So when the positive net working capital is there, that indicates the liquidity buffer, while negative net working capital shows the potential financial stress. Okay, so it should be always a positive one, right? That needs company. The company needs that working capital, right? Net working capital to run the business very smoothly. It is a key measure of short-term financial health, right? If the positive working capital is there, that means the company's financial health is very good. Okay. In aggressive working capital financing policy, A, all working capital is financed by the long-term funds. B, only permanent working capital is financed by long-term, rest by short-term. Or C, both permanent and temporary working capital financed by long-term funds. And D, entire working capital financed by the equity. Okay, so these options are expressing about the aggressive working capital finance policy. So that option B is correctly expressing the aggressive working capital finance policy, where the permanent working capital is financed by long term and rest is by the short term. Aggressive policy relies heavily on short term borrowings to finance temporary working capital, right? It is high risk, high return because short term funds are cheaper but increase financing risk. Okay. The cash conversion cycle (CCC) measures: A, time taken for fixed asset to be depreciated. B, days inventory outstanding plus days receivables minus days payable. C, average collection period into inventory turnover. Or D, credit policy efficiency. So the right answer of this question is option B. The cash conversion cycle is equal to days inventory outstanding plus days receivable minus days payable. Okay. CCC shows the time taken to convert investment in the inventory and receivable into the cash. So when we convert those investment, right, into the inventory and receivables into the cash, okay, after accounting for payables, that means minusing the accounting payables, whatever the remaining is, that is your CCC. So lower the CCC, higher the efficiency. Understanding? When the CCC is lower, the efficiency is higher, right? It integrates inventory, receivables and payables management. Okay, getting it? So lower the CCC, that means the time taken to convert those investments, inventories, investment is into inventory and receivables into the cash. That time is less, that means efficiency is higher. Okay. Which current asset is most liquid? Inventory, accounting receivables, prepaid expenses, or cash? It is what? It is cash. Okay. Current asset which is more liquid. Liquid, that means which is easily convertible into the cash. Okay. So cash is obviously it is already liquid, so it is more flexible to transact, right? So that is why it is called the most liquid. Cash is the most liquid asset as it can immediately settle the obligations. Getting it? Whatever the obligations, short-term loans and all you have, payables you have, that can be easily payable. That is why it is called more liquid. So receivables need collection, right? Inventory needs sale, and prepaid expenses cannot be converted back. Correct. So liquidity ranking, when we show that into this formula, like cash is greater than receivables, receivable is greater than inventory, and inventory is greater than prepaids. That means this is the cycle actually, right? Cash, receivables, inventory, prepaids. Okay. So when cash is more liquid, these things can be done very easily. Which working capital policy maximizes the risk? Aggressive policy, conservative, matching, or hybrid? Okay, so that aggressive policy, okay, aggressive working capital policy maximizes the risk, as we have seen the question on that. Aggressive policy depends heavily on the short term, right? Short term borrowings for even part of the permanent working capital, right? While it lowers the financing cost, it maximizes the liquidity risk due to the refinancing and interest rate fluctuations, right? Which of the following item is not part of working capital? Trade receivables, inventory, plant and machinery, or cash and bank balance? What is it? It is plant and machinery. Okay, it is not the working capital. It is not comes under the current asset or current liability, correct? So that is why it is not considered as a working capital. Trade receivables, inventory, cash and bank balance, these are current assets and current liabilities, right? There is no liability, but these are current assets. Okay, so working capital, that means current asset and current liability. There is no fixed asset or fixed liabilities, right? So plant and machinery is fixed asset, so it is not considered as a working capital. It's so easy. Zero working capital means current asset is equal to zero, current liability is zero, current assets is equal to current liabilities, or current assets is greater than the current liability. It is what? Current assets and current liabilities are similar. That means zero working capital. Okay, zero working capital, that means what? Your current assets and your current liabilities both are similar. Okay, you have no excessive current assets, okay, compared to the liabilities, so that means you have no working capital. Okay, which of the following reduces working capital requirements? A, extending credit period to customers. B, maintaining high level of inventory. C, increasing creditors payment period. Or D, offering cash discount to the debtors. See, these MCQs that we are discussing here are really very important, because when you practice those MCQs more and more, right, it will create the confidence into the you. So you will able to answer the questions, because through the MCQs you are not just practicing the MCQs, you are also getting some new concepts in that chapters, right? So it will be very beneficial. So practice more MCQs. So option C is the correct answer. When suppliers extend credit, the firm can delay cash outflow, right, and reducing net working capital needs. On other hand, extending credit to the customers or holding excess inventory increases working capital requirements, right? Liquidity versus profitability. Okay, liquidity versus profitability trade-off in working capital management. A implies more liquidity always increase profitability. B, less liquidity reduce risk. C, high liquidity reduce profitability and low liquidity increases risk. Or D, liquidity and profitability are unrelated. What is it? Option C. High liquidity reduces profitability and low liquidity increases risk. Okay, understood? So maintaining high liquidity, cash or idle assets reduces returns as funds are not invested productively, right? And too low liquidity may cause inability to meet the obligations, increasing insolvency risk, right? So efficient working capital management seeks an optimal balance. So it should be balanced. It should not be more, it should not be lower. It should be balanced. Okay, then only your working capital will be accurately used. Working capital refers to, this is the very basic question. Working capital refers to A, long-term funds invested in the fixed assets. B, excess of current assets over current liabilities. C, net profit retained in the business. Or D, shareholders equity. What is working capital? So right answer is option B. Okay, what is working capital? It is excess amount of current assets over liabilities. Okay, see, working capital means current assets minus current liabilities. So whatever current assets you have, if you minimize the current liabilities from that, the remaining amount will be your working capital, right? Why working capital is important? Because it shows the liquidity and short-term financial health of a company, right? So to run the business daily functions, company needs working capital, right? So excess or the minimum working capital you if you have, the company will be functioning very smoothly. If you don't have working capital, that will be very hard to the company to run the business, right? So positive working capital indicates a firm's ability to meet the short term obligations, that means the short term loans and short term payments, correct? Whereas negative working capital suggests potential liquidity issues. So it will be not so beneficial for the company if the company is not having the minimum working capital to run the business, right? It is a measure of operational efficiency. Getting it? So that is why working capital is important. It will give you efficiency in a daily working uh, operations. Next, which of the following is the example of spontaneous source of finance? So first thing you need to understand what is spontaneous. Spontaneous finance, that means the money you are having from your operations, right? Or automatically the money is generated, right? So what is the source of that? From where the company can generate the money automatically, right? Commercial paper, bank overdraft, trade credit, and term loan. Trade credit. Okay. See, we'll have the explanation of all the options. Commercial paper is what? It is a short-term debt instrument issued in the market. Okay, in the money market, requiring formal procedures. So it will not give you the automatic money, right? The spontaneous source of money, right? Bank overdrafts also needs prior sanctions from the bank, while term loans involve formal agreements and repayment terms. So both the commercial paper and bank overdraft both needs the some kind of uh, technical things or some kind of documentation things, right? In contrast, trade credit arises automatically when suppliers allow businesses to delay payments for goods or services, or sometimes it is also called when the uh, supplier is having rent on something. Okay, that particular other person or other company is using some of the things, right, and renting them. That is also called trade credit, right? Since it comes naturally with the operations without negotiations, trade credit is the best example of the spontaneous source of finance. Next, this is very important question. Okay, focus here. The very high current ratio, okay, if the current ratio is 3 is to 1, generally indicates, okay, so basic thing or the normal current ratio which is required, that should be 2 is to 1, but it is 3 is to 1. So what does it mean? What is it indicating? Excellent liquidity without drawbacks, or the B option, over investment in current assets or inefficient asset utilization, or C, that is balanced capital structure, or D, minimum risk of insolvency. What is it? What could be? If the current ratio is more than 2 is to 1, if it is 3 is to 1, that means over investment in the current assets or inefficient asset utilization. The company is not properly using the current assets. Okay, company is not having the minimum current asset. Okay, both may be the reason. Getting it? So while the current ratio above 2 is to 1, that shows the safety. But what happened? An excessive high ratio may indicates the idle funds locked, right, in the receivable or inventory. So whatever money which you have receivable, or if you have inventory, that amount is locked. Okay, this leads to inefficiency and reduced profitability, because your current supply of money or current money that is smoothly coming in the what the company, right? So that is locked. So it may be sign of a reducing profitability or leading to the inefficiency of a company's function. Too much liquidity may mean missed opportunities for higher returns. That is also be the reason. The operating cycle concept is used to determine why this operating cycle concept is used for a long-term solvency of the firm or profitability from the sales, working capital requirement, or depreciation method. What is it? It is working capital requirement. Okay. See, operating cycle means time taken from purchase of a raw material to the production, sales, and cash utilization. Okay, longer cycle increase working capital needs. How much long work cycle is, that much working capital you need for your company. Correct. So shorter cycle reduce funds tied up, right? If the cycle is shorter, it will require less funding, right? It is a fundamental concept of working capital management and linking liquidity with the efficiency. So basic thing is that we know the working capital, why working capital is necessary to run the daily functions of a business, right? If the operation cycle is longer period, obviously we need the longer or maximum working capital. So operating cycle is totally related to the working capital requirement or working capital management. Permanent working capital refers to, what is permanent working capital? A portion of a current assets financed by the short term borrowings. B minimum level of current assets required at all times. C excess cash kept for emergencies. Or D seasonal increase in working capital needs. What does it mean? It means minimum level of current assets required at all time. Okay. See, permanent working capital is the baseline investment in the current assets. Okay, like a minimum stock or receivables. These are the examples of permanent working capitals, right? That firms must maintain continuously because it will generate the money, right? The the cash flow, the money flow in the company. It is usually financed from the long term sources, right? When a company is investing long term, that long term investment will give you the current or the uh, recurring money, right? Like interest you will have, right? Temporary or fluctuating working capital arises during the seasonal or cyclical demand. When the temporary fluctuating working capital arises, okay, it is maximizing, it is increasing during the seasonal or cyclical demand. Clear? So basically, the permanent working capital, what does it mean? The money that you're having, the money that you're receiving, the source of a money is what? Your permanent investment, your long term investment. Okay. So basic thing, the money which is coming from the long term sources, that is called permanent working capital, and that thing company should maintain. Next, which of the following is not determinant of a working capital requirement? A nature of a business, B seasonality of operations, C dividend payout ratio, or D credit policy. That is dividend payout ratio. This is nothing to do with your working capital, right? See, working capital management influenced by the operating cycle, credit policy, seasonality, and nature of a business. These all terms are determinants, okay, the factors which are influencing the working capital management. Correct. But the dividend payout affects retained earning, capital structure, but not day to day working capital requirements. Okay. The work of a dividend payout is different, right? When the dividend is come and we need to pay to the shareholders, that is your dividend payout, right? So retained earning which the company is having, from that retained earning company is paying to the dividend, the shareholders, getting it? So that will affect to your capital structure, your retained earning, right? It will not affect your working capital management, getting it? So hence it is not direct determinant of a working capital. The main objective of a working capital management is to maximize sales, B ensure liquidity and profitability balance, C reduce taxation, or D increase fixed assets. What is the main objective? What is the role of working capital management? Obviously to ensure liquidity and profitability balance, right? And also the efficiency of a company business. Working capital management balances liquidity. Liquidity means ability to pay obligations. Obligations means the recurring payments, right?
with profitability, avoiding excess idle funds. Correct? Too much liquidity reduces profitability, while too little liquidity risk insolvency. Right? It should not be that maximum, it should not be that minimum. It should be required, right? It should be balanced. It should be that much of which is necessary. It should not be more high, it should not be more lower. It should be that how much you need, that much it is required. Next, conservative working capital financing policy implies, okay, a, financing only permanent working capital from long term funds. B, financing both permanent and part of temporary working capital from long term funds. C, financing all working capital from short term funds. Or D, financing working capital solely from trade credit. So the right answer is option B, financing both permanent and part of temporary working capital from long term funds. Okay, that is conservative working capital. That means company need to continue with that, right? Conservative policy reduce risk by financing even part of a temporary working capital through long-term funds. So company basically the things or the fund which is coming from the long-term investments or long-term sources, that is called your conservative working capital. Okay, we can call it, or it is a continued working capital, the fixed working capital, right? This increases safety but reduces profitability due to higher cost of long-term funds. If the investment is longer, investment is more, okay, the return will be more, right? So it may increase your working capital. So it is a low risk low return approach. What is it? The conservative policy. Which of the following ratios best measures liquidity? So current ratio is the best ratio, right, which measures the liquidity. Current ratio is equal to current assets minus current liabilities that we have seen. It directly measures the ability to pay the short term obligations, right? So that means the ratio of current asset and current liquidity, okay, comparison of both, how much current assets you have, okay, compared to the current liability, that shows the company's liquidity health, right, or the financing health. A ratio 2:1 is considered ideal. Inventory turnover measures efficiency, return on assets measures profitability, while debt equity measures the solvency. The matching or hedging principle in working capital management suggests using only equity for financing, or B, matching long term assets with long term funds, short term assets with short term funds, and C, financing short term assets with long term funds only, or D, financing long term assets with short term loans. It is option B, matching long term assets with long term funds and short term assets with short term funds. Okay, that is your matching hedging principle of working capital management. Okay, matching principles aims at reducing risk and cost by aligning financing sources with duration of asset usage. Okay, fixed capital, permanent working capital are financed by long term funds, while fluctuating current assets are financed through the short term borrowings. Okay.
Which recruitment source is considered external? A, employee referrals, B, promotions, C, campus recruitments, and D, transfers. So that is campus recruitments. Okay. See, campus recruitment is usually everyone knows, right? In an institute or college, some big companies, multinational companies come to conduct this campus recruitment. They hire some new or fresh candidates for their company. Okay, they will give you, those companies will give you some training, some internship. Okay, after that, when you complete your internship, complete your training, they will directly hire in the company. Okay, so this is campus recruitment. It brings fresh talent from educational institutions, providing new perspective and skills not available internally. Okay, so company does not have this campus recruitment. They will hire some candidates from the college or institutions. Okay, expanding the talent pool. Human resource planning primarily aims at A, determining salaries, B, ensuring right people at the right place, time and cost, hiring external consultants, and D, maintaining discipline. So human resource planning is primarily the work of human resource planning, or the focus of human resource planning is to ensuring right people at the right place, time and cost. Okay. So basically HR planning, human resource planning, it ensures the availability of qualified employees in the required numbers, right? So whatever the number of people or number of employees required, the HR planning ensure that the quality of employees will be selected, right? It aligns workforce supply and demand with the organization goal and future strategies. So HR planning basically selecting, recruiting at the right time, at the right cost, okay, for the benefit of company, for the benefit of organization, to complete the goals. Okay. Internal recruitment is preferred when A, seeking fresh perspectives, B, promoting employee morale and retention, C, hiring entry level position, and D, expanding to new locations. So when the internal recruitment is preferred, when the promoting employee morale and retention, to promote employee morale and retention, the internal recruitment is preferred. See, internal recruitment motivates employees, enhance loyalty, and utilizes existing talent efficiently. That will reduce the recruitment cost and time. Okay. The main objective of selection is to A, reduce employee turnover, B, hire candidates most suitable for the job, C, increase training cost, and D, satisfy labor unions. So now this question is about the selection. Okay. The objective of selection is hire candidates most suitable for the job. Okay. Very easy question, but it should be understandable, right? Then only you can able to answer properly, you can able to select the right option properly. Okay, try to understand the question first and then eliminate the wrong options. Okay, see, every job has their own specification, right? For every role there are different specifications. So selection is what it aims to identify candidates whose skills, knowledge and abilities match the job requirements. Okay, in HR term we call it JD, job description. So every role has a different kind of job description, so candidate must fulfill those job descriptions. Okay, the job role should be uh, specified with the particular terms, right? Ensuring optimal performance and organizational fit, so that candidate should be fit for that role. It will be beneficial for organization and for the employee as well. Next, induction programs are designed to, what is induction? Okay, teach advanced technical skills. B, familiarize new employees with organization policies and culture. C, conduct performance appraisal, and D, increase production output. So basically induction program is the beginning of the job. Getting it? When you start your job, the induction will be happen. So familiarize new employees with the organization policies and culture. This is the right definition of induction. Okay, once you get selected, the induction procedure will start. So HR or any other HR team member will give you a induction. Okay, that means telling about the company, the job, the policies, what is the environment, the culture of the company. Everything will be shared with the employee. So basically induction program helps new hires adapt quickly, understand job responsibility, organizational structure, culture, reduce anxiety and increasing engagement and productivity. Okay, so induction call will help the new hiring to understand the company culture, how this company works, the job role, everything about the company and the job. Okay, so the new hiring or the new employee will be working very easily, or maybe without anxiety, without the hesitations. Okay, it will be familiarizing procedure. On the job training is most suitable for entry level employees, managers only, employees learning through actual work tasks or freelancers. So on the job training is most suitable for employees learning through actual work tasks. So people who are actually working, already working in the company, for those people on the job training will be suitable. On the job training enables employees to learn while performing their job, improving skills, efficiency and immediate application, making it cost effective and practical. Okay, so for example, there is a developer, okay, who is working in a company, but now the AI is emerged, correct? So along with doing job, he will understand the AI. Okay, that training will be given to that developer. That is called on the job training. Next, training versus development difference is that A, training is long term, development is short term. B, training focuses on current job skills and development focuses on future role and growth. C, training is optional, development is mandatory. Then both are identical. What is it? It is training focuses on current job and development focuses on future role and growth. Training addresses current job recruitments requirements, while development prepares employees for future responsibilities and career growth. Okay, so basically training is what? Training for the new opportunity, training for a new job or new requirements. Okay, to fulfill that requirements, to do that kind of work, you need to be trained. That is called training. Okay, and what is development? Development means developing yourself or developing something for a future benefit. Okay, future responsibilities, career growth. That is the long term one. Training is a short term period, we can say, which is fulfilled or which is done for the short term goal. Okay, and the development is for future goals. So this is the long term career growth. Okay, emphasizing skill enhancement and managerial readiness. Which selection tool is best for evaluating behavioral competencies? A, written test, B, interview, C, assessment center, and D, resume screening. Okay, what is it? It is assessment center. Assessment center use stimulations, group expertise, and role plays to evaluate interpersonal skills, decision making, leadership, going beyond the technical knowledge. Human resource planning requires forecasting of. Why human resource planning requires? A, future skill requirements. B, budget allocations only. C, production targets. And D, marketing trends. What is it? It is option A, future skill requirement. Okay, so human resource planning required for forecasting future skills requirement. Okay, HR planning involves predicting the future demand and supply of workforce skills, ensuring that the organization has the right people to meet strategic objectives. That is called HR planning. Okay. Next one, the main advantage of structured interviews is A, flexibility in questioning, B, standardization and reduced bias, C, faster selection process, and D, no preparation needed. So main objective of structured interview is standardization and reduced biasness. Okay, all right. Structured interviews ensures consistency, fairness, comparability, reducing interviewer bias, improving the reliability of candidate evaluation for selection decision. All right. So this is all about today's video, everyone. If you need any topic MCQs, just put a message in a comment box. I'll take those MCQs in the next session. Okay. Thank you so much. Have a great day. See you in the next session. Recent HRM trend emphasizing employee self-direction is A, outsourcing, B, employee empowerment, C, job rotation, or D, hierarchical control. It is what? It is employee empowerment. So let's understand what is employee empowerment, right? Employee empowerment involves giving employees autonomy, that means independence, responsibility, and decision-making authority, which increases motivation, engagement, and productivity in modern organization. So basically, it is little bit of a freeness to the employees to work by their own style, right? So what will happen if such kind of things are happening in the organization? So it will increase the motivation for doing work or achieving the target. engagement of the employee in the work, getting it, productivity in the modern organization, right? So employee empowerment is nothing but the giving the some kind of autonomy, responsibility and authority to take a decision. Okay. HRM primarily focuses on, okay, human resource management primarily focuses on A, managing machines in the organization, B, developing organizational policies, C, managing people to achieve organizational goals, or D, financial planning. So mainly HRM will focusing primarily on the managing people to achieve organizational goals. So firstly, understand what is HRM. That means human resource management. So it is concerned with the recruiting, then developing, motivating, and retaining the employees to achieve organizational objectives. Okay, so every business, every organization have their own target, and to achieve that target, you have to manage your human resource. Correct. So human resource management is what? Recruiting right person, developing that person, okay, motivating them to complete the target, right, and retaining those employees in the organization to achieve the goal. Okay, it treats employees as assets rather than cost, right, focusing on both productivity and well-being. So that is why HRM, okay, mainly focuses on managing the people. Which perspective emphasizes HR as a strategic partner in achieving organizational goals? A. Operational perspective, B. Human capital perspective, C. Functional perspective, or D. Administrative perspective. So it is what? Human capital perspective. Okay. So the human capital perspective, okay, sees the employees or views the employees as a valuable assets rather than the cost, right? HR contributes to strategic goals by enhancing skills, motivation, and performance, aligning workforce planning with the business strategy. Okay, which factor significantly influences HRM practices in modern organization? A. Technology, B. Socio-cultural environment, C. Legal regulations, or D. All of the above. So in HRM practices in modern organization, the factors are all of the above, like technology, socio-cultural environment, legal regulations, all are important, right? HRM influences by multiple internal and external factors. As I said, all the things, okay, including technology, culture, laws, globalization, economic conditions. These all are both factors, internal and external, right? Effective HR policies consider all these to remain relevant. So basically, what does it mean? HRM means to manage all the factors, whether it is internal, whether it is external, to achieve the organization's goals, right? Strategic HRM links HR practices with A. Financial accounting, B. Organizational strategy, C. Marketing plans, and D. Production schedules. So what is it? It is organizational strategy. Strategic HRM ensures that HR policies support the long-term goals of the organization, integrating human resource planning, talent management, and performance evaluation with the strategic objectives. Okay, which approach views employees as a resource to be developed and optimized? A. Administrative approach, B. Resource based approach, C. Behavioral approach, or D. Transitional approach. Okay, remember, you can also give your answer in a comment box. Okay, so what you will do, when your answer is right, you can give yourself as a 2 marks, okay, plus 2 marks. Getting it? So after the end of the video, you will calculate your overall score and you will share in the comment box. Okay, so right answer of this question is option B, resource based approach. See, the resource based approach sees employees as a critical competitive advantage. Organizations invest in employee development to maximize knowledge, skills, and commitment. Okay, this way it will also beneficial for the company to maximize their assets and achieve their targets. Technology driven HR trend includes C. Digital recruitment and HR analytics, B. Manual record keeping, C. Traditional appraisal method, or D. Face to face only training. It is digital recruitment and HR analytics. That is your technology driven HR trend. Technology has transformed HRM through online recruitment, performance management software, AI-based analytics, and e-learning platforms, increasing efficiency and data-driven decision making. Which perspective in HRM emphasizes psychological and social aspect of employees? A. Behavioral perspective, B. Administrative perspective, C. Strategic perspective, and D. Functional perspective. It is behavioral perspective. Okay, when it is always say the perspective of psychological or social, it is directly behavioral perspective. Okay, focuses on motivation, leadership, communication, and group dynamics. It treats HR as a driver of a human behavior, ensuring employees satisfaction and organizational effectiveness. One of the major challenges in contemporary HRM is standardized production processes, B. Globalization and diversity, C. Budget cuts, and D. Routine paperwork. Okay, so one of the major challenge in contemporary HRM is your globalization and diversity. Okay, globalization has introduced challenges such as managing cultural diversity, cross-border teams, international HR policies, and making HRM more complex and strategic. Okay, so just because it is a broad concept, it is more complex, it is more complicated and strategic. HRM practices focusing on well-being, work-life balance, and flexibility is called A. Strategic HRM, B. Employee welfare, C. Human resource accounting, and D. Performance appraisal. What is it? It is employee welfare. Okay. Employee welfare programs improve morale, reduce turnover, and enhance productivity. Modern HRM emphasizes work-life balance, flexible hours, and wellness initiatives as a part of employee welfare. According to Porter's diamond model, which element creates a pressure for innovation within domestic firms? So we have discussed the Porter's diamond model. What is it and what is the name of that diamond model? Okay, so option A, strong domestic demand, B, governmental subsidies, C, absence of competition, and D, abundant natural resources. So if you have watched the previous session in which we have discussed the Porter's model, so you can give an answer in a comment box. Okay, whatever A, B, C, D, just give an answer in a comment box. I'll give you some time for it. All right, so option A, strong domestic demand, right? See, Porter suggests that sophisticated and demanding domestic customers pressures firms to innovate and upgrade, right? So that is the major reason why the firms are innovating and upgrading their products. Even in the product life cycle, we have seen that, okay, once your product demand increases, okay, day by day or after some time, it will decrease the demand. Clear? So you have to innovate your product, because when the recession period, sorry, not recession, the decline period is every firm is facing, right? That time the demand decreases, your product is not upgraded right now. Okay, so you should upgrade that product and you should innovate something in that, so customer increase their demand for your product. Clear? So here in the Porter's theory, what Porter is suggesting, domestic demands can influence the firm's production or firm's innovation and upgradation policies or functions, right? If the domestic demand or domestic customers, okay, demanding for a particular product more and more, then firms need to upgrade those products. Okay, this helps firms anticipate global consumer needs, giving them competitive edge in the international market. Okay, so that is how the firms can grow and firms can be competitive in the market. Clear? So strong domestic demand is the correct answer. Next, under mercantilism, which policy would a government most likely implement to protect its economy? Okay, to protect the gold and silver of that company, to protect the strength. Clear? Free trade agreement, import tariffs and export incentives, floating exchange rates, or factor mobility program. So obviously it is import tariffs and export incentives. Clear? See, mercantilists policy support protectionism. Protection against what? Their strength, their wealth, right? Imposing tariffs on imports to reduce foreign goods and subsidizing export to increase national wealth. So more the export will be, the more your wealth will be increasing. Clear? It assumes wealth is finite and trade surplus strengthen national power. So here in the mercantilism theory, what happens when the company or when a country, okay, to strengthen their wealth, okay, so basically country considers their wealth is gold and silver, okay, to strengthen their wealth they increase the export and reduces the import, and for that reason they can implement any policies, like a government is intervening in the global market to reduce the import and increase the export. What government is doing, they are imposing tariffs on imports, so imports will be reducing, okay, foreign goods will be coming less in the market or in the domestic market, right, and the exports will be increasing. So when the exports are increasing, obviously your wealth will be increasing, correct. So that is how the countries are what we can say, increasing their wealth. Clear? Next, in the maturity phase of product life cycle, a company is most likely to focus on innovation and research and development, face declining demand, increase cost efficiency and standardize production, or D, invest in product diversification. So right answer is option C, increase cost efficiency and standardize production. Okay, in a product life cycle, when a maturity phase is there, companies most likely to increase the cost efficiency and standardize production. Okay, so what happens in a maturity rate, maturity phase? See, as the product reaches maturity, competition intensifies, right? The price becomes a key factor. Firms focus on standardization, cost leadership, and efficiency to maintain profit margin as sales growth slows. Why is mercantilism criticized in the context of global trade development? It discourages industrialization, it supports free trade, it views trade as mutually beneficial, it leads to trade wars and colonial exploitation. Okay, so mercantilism criticize, that means it leads to trade wars and colonial exploitation, correct, because every country is focusing on what, increasing their wealth, that means securing their gold and silver. Clear? Correct. See, mercantilist policies led to aggressive export strategies and military backed trade monopolies. Correct. This often escalated into colonialism and conflict as nations sought to control resources and market for their own gain. Okay, so strictness were followed by the countries, and that is why the trade wars were happened and colonial exploitation was also happened. Clear? Which factor would mostly likely to cause a developed countries to lose its early stage production advantage in product life cycle theory? Okay, emergence of cost efficient producers in developing countries, stronger patent laws, high domestic demand, or increased research and development investment. So that is emergence of cost efficient producers in developing countries, right? As a product matures and becomes standardized, developing countries can produce it more cheaply due to the lower labor cost. Okay, but this happens only in the maturity phase. Clear? Developed countries lose their advantage and often shift production offshore to remain competitiveness, correct. To stay in the market, developing countries may take this kind of steps to be there in the market, okay, to keep their product alive in that market. Which condition would contradict the assumption of Heckscher rule in theory? So basically there is a one option who is contradicting the assumption of Heckscher-Ohlins theory. Which option is that? A. Uniform production technology, B. Mobile factor within countries, or immobile factors between countries, or product differentiation and brand loyalty. So right answer is immobile factors between countries, between two countries. Okay. See, Heckscher-Ohlins assumes perfect competition, correct, and homogeneous products. When branding and product differentiation dominate trade decisions as seen in the real markets, the theory's assumption break down, limiting its real world applicability. Okay. Next question. Which of the following best explains a country's persistent competitive advantage in high-end luxury brands? Labor abundance, mercantilist exports, Porter's firm strategy and rivalry, or D. Standardized production? So right answer is option C, Porter's firm strategy and rivalry. Clear? Porter's argues that the strong domestic rivalry and unique firm strategies drive innovations and global competitiveness. Correct? That is what we have seen in the Porter's theory. Correct? Countries like France or Italy maintain luxury brands dominance due to competitive pressure and strategic firm structures. Right? So these are the countries who are exporting or who are good at their products. Correct? They are having dominance in their brand, their luxury brands, and due to competitive pressure and strategic firm structure. Okay, that is the reason behind it. Understood? So that is the right answer, C, Porter's firm strategy and rivalry, which is explaining the country's persistent competitive advantage in high-end luxury brands.
Which of the following qualifies as a foreign direct investment? So four options we have, and one of them or two of them or three of them or maybe all of them are points which are covering or which are stating that this is the FDI. Okay. A foreign company acquiring 15% equity in an Indian company. B. Purchase of Indian government bonds by foreign institutions. C. Investment in Indian stock market through mutual funds. And D. Establishing a new manufacturing plant in India by foreign firms. Options are like only A and D, only B and C, only ABC, or all of the above. So the right answer is option A, that is A and D only correct. Okay, when you have 15% equity in Indian company and establishing a new manufacturing plant in India by foreign firms, right? So these are the two types of FDIs that we have already seen in the theory session, right? See, FDI actually involves at least 10% equity should be there in Indian companies to call it as a FDI. That is important. Then option A qualifies as a FDI because the foreign firms acquire 15% equity. Correct. Minimum criteria is 10%, and it is the in the option we have seen this, it is 15%. Right. So obviously it is there. It is called as a FDI, right? Option D qualifies because establishing plant is direct investment, right? And B and C are passive investment. These are not FDI, but it is called FPI, right? But the question was asking the options which are qualifying as a FDI. So only A and D is qualifying as a FDI, correct? Because one is having 15% investment and second is actually establishing a manufacturing plant, correct? Next, which of the following statement is or are true about FPI and FDI as well? FDI is a long-term investment. FPI is a more volatile than FDI. FDI brings in managerial control. FPI involves active control of business. Okay. Options are AB, ABC, BCD, or all of the above. So right answer is option B, that is ABC. A, B, and C. Okay. FDI is a long-term investment, that is correct. FPI is more volatile than FDI, that is also correct. FDI brings in managerial control, correct. Okay. FPI involves active control of a business. No, that can be happened in FDI when you are establishing a manufacturing plant over there. Correct.
See, FDI is intended for long term, right? Presence and often includes management control or participation. In contrast, FPI is a quick in and out. Okay, once you have invested for short term, you have what we can say, withdraw all the money, that is done. That is called FDI. Okay, quick in and quick out, and hence more volatile. That is why it is called volatile, because it's not for a long term, it is for short term. Once you have investment for some time, you will withdraw your all money with the profit. Correct? That is happening in the FPI. FPI does not allow investor and any say in how the company is run. So D is incorrect. Okay. So basically, FPI is not like that thing where you have a business in another company, or sorry, another country, and you're having a manufacturing hub or anything. Okay. It's not like that. It is happening only in a long term period. That is from FDI. Okay. That the source is FDI. But FPI is just an investment where you can invest in another company in another country. Okay, that is only FPI. Next, which of the following are benefits of FDI for the host country? Right? Employment generation, technology transfer, sudden capital outflow, improvement in foreign exchange reserves, and skill enhancement. Right? Right answer is option A, B, D, E. Right? C is not there. C. FDI can help the host country by generating jobs, bringing new technology, strengthening foreign exchange reserves, right? These all points we have already discussed in the theory sessions. If you are new to this channel, please subscribe the channel and just go to the description box. You will find a link over there. Okay, click on that link and watch the previous videos as well, because it is very important that you should clear your concept. Okay, obviously through the MCQs we'll cover it, but the more and more points will be covered in the theory session only. So watch that video as well, so you will be covering the whole topic. Correct? Next, it also leads to training and skill enhancement for local workers. However, sudden capital outflow is more associated with FPI, not FDI. Correct? Next, which of the following sectors in India attract the highest FDI inflow as per recent trends? Right? Service sector, telecom, retail trading, computer software and hardware, and education. See, this question is most important. Make it most important. Okay, this question. So right answer of this question is option C, only A and D. Right? Service sector, computer software and hardware. These are the sectors in India attracts the highest FDI inflow. Right? In recent years, India has received maximum FDI in service sectors like finance services, consultancy, and IT software industries as well. Right? While telecom, retail do attract FDI, they are not top contributors. Actually, where it is services, whether it is IT softwares, whether it is telecom, retail, okay, all are coming in India as through the FDI. But services and IT, like IT is also a service sector, right? These are the industries which are coming maximum in India, okay, as compared to telecom and retail as well. Correct. Education has FDI limits and receives less investment compared. So basically, education has its limits. That much of education facilities or services only available, okay, to come in India. Uh, Along with that, sorry, apart from that, okay, or exceeding that limit is not available or not allowed in India actually. Correct. Next, which of the following are routes through which FDI can be brought into India? Automatic route, government approval route, hybrid route, strategic route, or brownfield investment? Correct. Right answer is option B, that is ABE. Right, hybrid route, strategic route is not considered. India allows FDI via automatic route, no prior approval, correct? And government route needs approval, that we have discussed, okay, in the theory session. Brownfield investment is a type of FDI, right, which is referring buying or expanding existing assets and in common in FDI mode, correct? Brownfield, that means you are acquiring the existing company or existing business. That is your type of FDI, brownfield, right? We have already covered all the types like horizontal, then we have vertical, right? We have brownfield, right? We have then what is it? And some of the types of FDI we have already discussed in the theory session. Okay, all the FDI types we have discussed, right? Greenfield is also there. Okay, so go and watch that videos as well. Hybrid and strategic routes are not recognized official categories. Okay, next. Which of the following statements differentiate FDI from FPI? This is very important. Okay, this is also, we should make it as a important. FDI leads to capital information, FPI does not. FDI is illiquid, FPI is liquid. FDI is speculative, FPI is strategic. FDI includes physical assets creation, FPI does not. Okay, so the right answer is option A, A, B, D. Correct? See, FDI creates productive assets like factories or offices, improving capital infrastructure. Right? Here you can see. Right? It is not easily liquidated, unlike FPI, which is highly tradable and hence more liquid. Correct? FPI is speculative, so C is incorrect. Speculative. Here it is saying FDI is speculative. No, FPI is speculative. Okay? Next. Which of the following may be negative impact of FDI on a host country? A. Repatriation of profits, monopoly or market domination, technology transfer, cultural erosion, or exploitation of natural resources. So the right answer is option A, B, D, E. Apart from C, all are correct, we can say. Okay, C is not correct, but all are correct. While FDI has many benefits, there are some challenges too. Okay, like profit repatriation, reducing forex, dominance of foreign firms, hurting domestic industries, and exploitation of culture or resources. Right? Sometimes FDI are coming in India or coming in the other country. Okay, FDI is possible in every country, correct? So they may exploit the cultural or resources, the natural resources, or that if that country, a particular country where FDI is coming, in that country the natural resources are maximum, those can be exploited, correct, in terms of raw material, understanding. So it is challenging too. Technology transfer is actually a benefit, not a negative. The question is asking about the negative impact. Okay, so these are negative impacts, correct? Technology transfer, how it is negative? It should be positive, right? Next. Which of the following qualify as FPI? Now FPI. The same question was asked, the first question about FDI. Now it is asking about FPI. Foreign investor buying shares on Indian stock exchange. Foreign investor buying debentures of an Indian economy. Foreign entity acquiring 12% equity in an Indian firm. Foreign mutual fund investing in Indian bonds. Foreign company buying real estate for personal use in India. Okay, so right answer is option A, that means A, B, and D only. Okay, C is not correct, E is also not correct. Okay, FPI includes financial instruments like shares, debentures, bonds that don't provide management control, right? So here you can invest like in another country, you can share, you can invest in shares, you can invest in debentures, you can invest in bonds as well. This is called FPI investment. Okay. C, that means 12% qualifies as FDI because it exceeds the 10% threshold. Correct. Here in the question, the 12% was asked in the C option. That is why we selected as a incorrect answer for that. E is neither FDI not nor FPI. Real estate for personal use is not categorized under either. Correct. See the question. Foreign company buying real estate for personal use in India. Here, one thing is important for personal use. It's not for business, it's not for investment, right? So it should not be considered as a FDI and FPI as well. Next, which of the following are features of FDI and not FPI? Right? This is kind of a confusing question. Okay, if it is the features of FDI, why they have asked not FPI? Why they have written here, over here, that it is not FDI's features? Okay, they could have said like which of the following are features of FDI only. Okay, and then full stop, nothing else. But to confuse you, okay, this kind of question can be asked: which of the following are features of FDI and not FPI? And they will give you some kind of options related to the FPI, but you need to understand the question first, right? So what we need to do in this question, we need to find out the features of FDI only and we need to ignore the FPI. Correct. Bring in entrepreneurial skills, subject to sectoral caps in India, cannot be withdrawn easily, associated with long-term relationship, bring in volatile capital flows. The right answer is option A, B, C, D. A, B, C, and D. E is not correct. Okay, this is related to the FPI, not FDI. Okay, see, FDI is a long-term commitment, so in that reason we bring it technologies and expertise as well and skills as well. In subject to caps in certain sensitive sectors. Okay, it is a subject to caps in certain sensitive sectors. E is not correct. FPI brings the volatile flows, not the FDI. Correct. So this is all about this question. Next question. Which of the following regulatory bodies in India oversees FDI and FPI, okay, respectively? RBI, SEBI, Ministry of Finance, Department of Promotion of Industry and Internal Trade, DPIIT, or NITI Aayog. Okay, so right answer is option B, A and D for FDI, B for FPI. A and D for FDI, okay, and B, SEBI for FPI. Okay. ठीक है. FDI is monitored by RBI, okay, under FEMA and DPIIT for policy and approval route. FPI, being a market-based financial investment, is regulated by SEBI. NITI Aayog is a think tank and does not regulate actually the investment, whether it is FPI, whether it is FDI. Okay,